for joining us today. Um, and hopefully you're going to find the session of of value and interest, and just setting what we were aiming to do is just going through every year we do our member insights, um, analyzing approximately 1 million members and what they're actually doing. And quite importantly, I think in the industry, there's a lot of surveys out there looking at trends. This is quite different in that it measures actual behavior of individual members, what their actual positions are. So it's not a survey, it's actually an analysis that's performed. And we've been doing this now for, this will be the 16th edition. We started doing this back in 2006. So I actually remember the first analysis that was done. I think before that there was very little known about individual members. It was still the earlier days of defined contribution funds. But I think since then the analysis has evolved quite a lot. And hopefully we're going to show you some new analysis, some new insights that you may not have seen before. I just want to introduce the team and also just take you through how we're going to run today. So with me today, we've got Ncheki Molefi, and she's going to be joining me, and she'll be presenting more on, what are the things that we can do to improve outcomes and addressing some of the issues that we see. I'll take you through the analysis. Ncheki is a regional executive for retirements, and I think she's been in the industry for many years, and she has first-hand knowledge and experience with trustees, with members. She's out there every day trying to help and make sure. So you're going to get no better insight from what's actually happening than Ncheki. She also manages a team in our Johannesburg office as well. And then we've also got supporting us today, we've got Belinda Sullivan. She's head of our consulting strategy. She will be assisting us if you have any questions. You can post your questions on the chat during the course of the presentation, and Belinda will assist in answering that. We will have a Q&A at the end as well that you can ask questions, but please feel free to post your questions. And again, Belinda is also very experienced, many years in the industry, and I'm sure can address many of the issues here. We also have Vicky Lange, who's head of our research, best practice, and the Alexander Forbes Academy. So it's really her and her team looking at all the advice. She's been involved with these member insights for many years as well. She'll also be assisting Belinda in answering your questions in the chat as well. And then we've also got, it wasn't mentioned in the press briefing, but I think it's important to mention it. We've got Don Andrews. He's head of our surveys at Alexander Forbes. They do the annual Manager Watch surveys, but Don's team actually puts together the numbers that you see here today. So I think, you've got all the experts that's put everything together. A good team. So hopefully we can answer all the questions that you have. Just in terms of what you'll get today, we'll go through a presentation. The presentation will be available to you after the session. In addition, if you have any, if you'd like one-on-one sessions with any of the experts here, we're happy to set up a time with you to go more in depth into some of the trends, the issues that we see here. You'll also be provided, there'll be a press release that's going out later today, and there'll also be a full report, quite an in-depth analysis. So after the session, we'll send it to all of you. It's quite a detailed report. We haven't been able to summarize it all here today, so we're just giving you an overview. The report has got lots of good information, and you're more than welcome to, if there's anything covered in there that we didn't mention here, please reach out to us as well. And then lastly, there'll be a recording available of today's session. We will send that out to you as well. And as I mentioned, we'll have the Q&A at the end, but please feel free during the course of the presentation to put your questions in the chat. And then for those of you that I haven't met yet, I'm John Anderson. I head up the investments, products, and enablements area in Alexander Forbes. And Yeah, I was also involved with the original member insights back in 2006, trying to figure out. So, and it's quite nice for me to see how things have evolved over the last 16 years. All right, so I think that's pretty much a running of today. But before we start, with the presentation today, we just want to take a few minutes to pay tribute to Alan Greenblow of today's trustee. For those of you that don't know, Alan passed away yesterday. Um, Really unfortunate. He was actually meant to be in this session, and a lot of us, were in contact with him, and unexpectedly passed away yesterday. So, just for those of you, just briefly, I mean, Alan Greenblow is the editorial director of today's Trustee Publishing. He co-founded Finance Week in 1978, so he's been involved in the industry for quite a long time, and he edited it from 1982 to 1995. He was the managing director of Business Day and Financial Mail. And then in 2019, he received the Sanlam Financial Journalism Award for Lifetime Achievement, which is quite significant. He also launched Today's Trustee in 2005, which is a quarterly publication mainly for principal officers and trustees of retirement funds. Um, and I'm sure all of you know that Alan played a very important role in encouraging critical conversations in the retirement industry, also in terms of retirement reform and broader issues affecting pension funds and members. As I mentioned, he was expected to be here today to participate and contribute. Um, so in the spirit of today's trustee, we'd like to have the debates and influence policy on matters and that impact many of the members that we're talking about and analyzing here today for you. And so we'd like to dedicate today's session to Alan and in tribute to him and all that he's done to the industry. So I think with you know, so let's have a look at the agenda then for today. We've got three real topics. The first is I just want to give you an overview. Some of you may not have been in some of the previous member insights, so we just want to do an overview of what it is, what it's all about. We'll then take you through the key statistics and findings, and hopefully you'll find that very interesting. And we've tried to focus more on the new findings that we haven't seen before. And then, as I mentioned, Ncheki will take us through what we can actually do to improve the outcomes, the so what. Um, and hopefully you're going to find that very interesting. It's got a lot of practical insights based on experience that we've built up. So to get started, why do we do member insights and why did we start this back in 2006? So essentially, when the retirement industry, over the last few decades, when members were defined benefit, employers looked at everything on behalf of the member. But I think when there was a conversion from DB to DC, there was more responsibility placed on individual members, and members needed the burden was placed on them. Yet, I think we didn't actually at the time look at what people needed, analyze their behavior, what the impact would be. So in reality, we've actually been building up and experimenting in essence on defined contribution for the best part of 2 decades, trying to work out how to improve member outcomes. And a key part for us at Alexander Forbes and also for the industry is actually to do regular checks on what are the insights from members, what are the issues that they're faced with, but also what are the actual statistics? Are they achieving? Are things improving? And what is working in practice? And that's why we started the analysis back in 2006. And I remember back then, nobody had analyzed preservation rates. It was the first time that was looked at, or decisions of people at retirement. And since then, a lot of that's been used in policy by the government, different stakeholders, but more importantly, by trustees, looking at their members, trying to understand what improves. And so that there's this continuous improvement in how we assist individual members, because at the end of the day, it's all about the individual member and assisting them, given that they've been a lot of financial responsibilities been placed on them in a defined contribution arrangement to analyze that. The analysis itself consists of close to 1 million members' records. For this specific analysis, we analyzed the records from January 2020 to December 2020, and that covers the COVID period during lockdown, with quite a lot happening during that period. We do this every year, and that was the year this was this particular year. What is new this year is that we've been able to enrich the data with further insights. So in the past, what we did is we looked at the actual the data on the administration platforms of the 1 million members, looking at retirement data. So it'll be your age, gender, salary, retirement savings, decisions being made, etc. But for the first time, we've been able to look at non-retirement data. So it'll be things like indebtedness, it'll be broader financial measures and demographic information. And we've been able to link the retirement data with that to provide better insights. I think this is the first time in the industry we've been able to link that. And we're going to show you some of the implications and knock-on effect of non-retirement issues which spill over into retirement decision making. So this is quite a nice addition to this, and in future we want to enhance this as well. As I mentioned, it's the largest membership sample in the retirement fund industry. The reason we do it, as I mentioned, is to gain insights into savings behavior and to look at where to make improvements and also where things are working, to essentially develop solutions, and that then helps with trustees, employers, as well as all the solutions provided, essentially to improve the outcomes. And as I mentioned, we've been doing it for the greater part of 16 years. So to start us off, it's quite important to understand what are the factors that affect retirement outcomes. And we, in this report, when you get it after today, you'll see that we've split out the sections into the different factors that impact retirement outcomes. But just a quick overview of what those factors are. The first one is how much people save. So how much pension they can purchase with their rand of savings. The second factor is expenses, because what happens typically in the retirement industry in occupational schemes, you'll have a total contribution rate, and from that will be deducted group risk premiums for death, disability, as well as for administration expenses, and the balance then goes to retirement. So there's this constant balancing between expenses and risk benefits versus retirement. And that is quite relevant now during the COVID period, where and we'll show you later, how group risk premiums, we expect that to be increasing and impacting your retirement savings. Yet group risk benefits are extremely important. Without it, most people won't have death, disability, and funeral cover in place, which was really required during the COVID period and still required, as we see the potential impact of long COVID, etc. The third and very important factor is investment returns after fees that the members invested in. And that one often gets a lot of focus. So we're not going to focus too much on that one today, because we believe that the other areas don't get enough focus. And often those have a huge impact on the outcomes at retirement. The fourth thing is that a member's salary progression also has an impact on their retirement outcomes. So because in a defined contribution arrangement, it's your savings is expressed as a percentage of salary. So to the extent that your salary increases, your savings would increase. However, if your salary increases, but your savings and the growth on that doesn't keep pace with your salary growth and your lifestyle, you could actually find that despite good salary growth, your replacement income doesn't keep pace and you're not able to afford that. So and people often forget that they think that great salary growth means a great replacement ratio. It doesn't. It actually depends on the growth between the salary and the investments, how much you've saved, and how much of that new salary increase you actually spend going towards retirement to maintain your new lifestyle, essentially on a higher salary base. Then the other factors are big one, number 5, is preservation. And that's the single biggest reason why in South Africa, most people don't get to a reasonable replacement ratio. And we'll unpack that a little bit. If that gets addressed, that will address many of the issues in the industry. And we are going to cover a little bit about the 2-bucket system a little bit later, which aims to address this. The 6th point that affects retirement outcomes is the balancing of short-term financial needs, including the use of credit, and then the balancing that relative to long-term savings. For the first time, we've been able to analyze the effect between those two, and actually look at the linkage between that. I think in the past there were various assumptions made and what it could potentially mean, the knock-on effect. We've actually been able to analyze that in addition to analyzing some other things as well. The other point is that the next factor is that the 7th point is how much of your retirement savings is used to generate an income versus flexibility and a legacy. Because once you get to retirement, you need to prioritize between an income for your pension, for your needs, but often people also have other goals at retirement, like flexibility, emergency savings, leaving a legacy. And that affects how you convert, and that's the 8th point, converting that savings into a pension. So all of these 8 factors affect the end result. And you can see it's quite a complex story that, we've put this on individual members. But through the years, we've tried to help members through the introduction of defaults, better communication, better legislation, to address all of these different factors. And a lot of good work has been done, but more still needs to be done and you'll see later, to improve the ultimate outcomes. I think with that in mind, we then let's have a look at what the stats are actually showing us. So the first thing is the overall demographic of members covered in the analysis. So we've got the average age of the data is 40 years for both male and female. So there's about and it's also roughly equally represented. In the past, you would have seen a bigger proportion of male members, in fact, but over the last few years, we've actually seen strides been made into more gender equality in the workplace, especially access to work, and that gap has actually closed now. What we also find, with the 1 million members is that they have different circumstances in terms of how many are divorced, living with a partner, married. What was very interesting for us is there's a lot of single individuals in the data, but specifically single mothers. And that's often not factored into how we communicate, what we do, and it does have an impact on how much people save, how they budget, etc. So for the first time, we've been able to get a better idea of the broader family dynamics of the membership to try and help understand why we're seeing some of the trends that we're seeing here. The average income was 19,000 Rand, and the average household income, if you group individuals, was about 28,000 Rand. Importantly, this was just the sample, the 1 million members. So it doesn't represent the entire population of South Africa. It's more representative of formally employed individuals in South Africa. Also, in terms of demographics, for the first time, we've been able to look at, as I mentioned, non-retirement data. So we've been able to link to various databases, and what is quite interesting is that you can see, here's some credit analysis we've been able to match about 87% of the individuals, so 87% of the 1 million. We had credible information to be able to estimate the figures that you actually see over here. Some important statistics is that the average annual income debt to income ratio is about 69%. And also there's about 5% of the individuals under debt review, and those are the individuals that would typically be highly stressed. What we did find interesting is that there's this Presage credit score. It's a score between 0 and 1,000 that tries to give an indication of an individual's risk in respect of financial resilience and credit. The higher the score, the better the individual is rated. So better decision making, better use of credit, more responsible, etc. 760 is actually a medium risk, so it's actually not bad. But remember, we're dealing with the population here that is the formally employed individuals. So it won't be the unemployed where people are getting loans unsecured, etc. This is formally employed individuals with predominantly medium to large corporates. So it typically, because our database excludes a lot of small to medium enterprises, but the overall, the average credit rating is actually not bad. However, there are members, and we're seeing it after COVID now, starting to take strain. The proportion of loans going into default is increasing. And also the debt to income ratio is increasing. We expect that to increase based on some other information we've got. But people that are highly stressed, sitting at about 5%. So, and that has a knock-on effect on retirement. It has a knock-on effect in the workplace, productivity, etc. And some of the relevance of this will become clear a little bit later. The other information that we've also got now is just in terms of where people are located. And you can actually see that the majority is sitting in Gauteng. That makes a lot of sense. Most businesses are up there. And then the next is in the Western Cape and KwaZulu-Natal, with some members in the other provinces over here. So this is as expected. What we may find in future here is people relocating, and given the flexible work with COVID, people not located in South Africa yet doing work, and we're definitely starting to see in specific industries, the IT industry where there's very specialized skills, legal, for example. There's quite a few industries where we do expect that going forward. You wouldn't have seen it in this specific analysis because this ends at December 2020. Since 2021, we've started seeing more people looking at those options, and that has implications for retirement funds, how they communicate, how they get to individuals, the channels that they use, etc., and making sure that there's sufficient support in these different regions to assist individuals as well. The other interesting one is obviously with the lockdown happening from last year, a lot of businesses switched to remote working, and digital became quite important. We've been able to have a look at individuals' usage of various digital channels, and this is quite an interesting one. You can see here that a large proportion of people actually do use various digital channels. Only 14% of the individuals don't have access to internet. That's quite an important statistic because a lot of the 1 million members are actually blue collar workers. We've got individuals in the mining sector, manufacturing, we've got people in rural areas, etc. The point is everybody's got a phone these days, and they might not have access to a computer, a laptop, etc., but they do have access to the internet, and they definitely have access to SMS. So although we don't show SMS over here, we would expect that would be, anybody with a phone can use that, so that should be at 100% actually. What is interesting is that large portion of individuals use WhatsApp, and we're starting to see WhatsApp becoming a channel to communicate with members, help them, assist them, etc. Very few people actually looking at Twitter. So I think when people look at Twitter, it'll often be your more sophisticated individuals. It'll be for other purposes, but for your average member, they're not looking at Twitter really. They're more on Facebook. I think that is, as expected, but WhatsApp by far is the preferred channel. But the main message I just want to leave here is we've definitely found since COVID, trustees having to relook at their communication strategies, in the past, it was either written or in the workplace, booklets, for example. Everybody's switching to digital. Um, but there's also still assumptions out in the industry that people don't have access to digital channels. That's actually not correct. The vast majority of people do have access and can use digital channels, even if it's blue collar, lower earners, etc. So it's important to start using those channels, but try and avoid ones that actually aren't effective. Um, and I think, but for trustees, it's important to have a range of these channels. And no longer you'd have one. You need a few of them to get, make sure you can properly engage with individuals. And this COVID has obviously accelerated the need for this. The other thing is that we've been able to have a look at the demographics of individuals in terms of their family, the household. So on average, there's about 0.89 children in the household. Remember, there's a lot of single individual that I mentioned before, also young individuals. Um, Also, this is based on the data that's there. So there may be some undercounting over here because if you've got an individual that's divorced, the children may only, and they had children, it might only count once on the one individual's record, not both. But that's the data that we've got. The point is there are multiple individuals in a household. And we have to, people often talk about the sandwich generation, it is real. And we're starting to see with COVID as well, people relooking at, how the families are structured. And that has a knock-on effect in weighing up the short and the long-term goals. And through COVID, we saw that people were under pressure and then hence needed to sacrifice some of the long-term savings to meet the short-term needs because they're supporting a household, etc. The vast majority, 44% of individuals have a car, 73% have a home, but also you can see in the vast majority of households, both parents or both parent or individuals work. So I think that's quite important. We would expect that a few decades ago, if you did this analysis, you would have found this statistic to be fewer, but these days there's more than one person in the household bringing in income, given what things cost these days, the financial pressures, as well as the dynamics in a household. So I think with that in mind, let's have a look at what the retirement outcomes actually are. And we've done a comparison versus previous years as well. And there are three key things I just want to point out over here. The first is that this year, the expected replacement ratio, so that's what people can expect at retirement as a percentage of their salary at retirement. This year is 40.51%. So for every 100 Rand that they have at retirement, they're expected to have a pension of 40 Rand and 51 cents. But the important stat for me actually is what's actually happening. This 40 is for actual active members, so it includes everybody, whether they're 25, 26, all the way up, what they're expected to have at retirement projecting forward. What's actually happening in practice is that people are experiencing actual replacement ratios of 31. These are all the retirees during the period under consideration. This year it's 31.47%. It's higher than last year's. Last year's was about 28%. So it has improved. The improvement is a result of predominantly, the cost of purchasing a pension. So the markets recovered last year after March. So again, people deferred retirement a little bit through that period. The markets recovered, but the big impact was that the cost of securing a retirement between 2020 and 2019 is better. So if you went and got a quote from an insurer for an annuity, it would be better. And the reason for that is that real interest rates increased. They are still at quite all-time highs. And therefore, we've seen a lot more life annuities being taken up, and that has benefited retirees this year. It's still a long way short, though, of the 75% that we expect. And that's as a result of many things. Decades worth of low contributions, no preservation, returns that maybe didn't keep pace, etc. But at least this year there has been an improvement, but it's mainly because of the better annuity rates. The second thing is that we're only seeing about 6% of individuals expecting to get to that ideal 75% of pensionable salary. That being said, though, although on the total 1 million members, we haven't seen a big change there, we have seen in certain industries and certain funds where they've been a lot more proactive, that things have improved quite dramatically. And Ncheki will take us through where we've seen change. So the averages have masked, where we have seen improvement. Ncheki will take you through where we have and what those funds are actually doing to improve outcomes, improve preservation, improve decision making. The reality is that we need more funds to do that, more employers to embrace those approaches, to see more of the 1 million members ultimately get that. In addition, we need more regulation, and there's some good proposals from National Treasury coming up to improve, in particular, preservation, which I'll take you through in a second. So to improve these outcomes, National Treasury has proposed what they're calling the two-bucket proposal. And now there's you would have seen a lot of this recently. We've done some work just to have a look at the Actuarial Society came out with some analysis. And we've also done some just having a look over a period. The reality is that some of the parameters of the two-bucket system still need to be set out. So we're just playing for illustrative purposes using the first bucket is 30% of your savings that you can use for short-term needs, and it's accessible. There has been talk that it may be up to a third, but we've modeled 30% just for illustration, and 70% always being preserved. So, and we think this is quite a good concept, but Ncheki can take you through, some of our views and next steps on that. We've done the modeling here, and on the whole, we can see quite a nice improvement in outcomes. People's savings being anywhere from 2 to 2.5 times better over a 35 to 40-year period because of this, even if they were to take their short-term bucket, essentially. And the reason for that, this graph actually shows it quite nicely. Here's at the bottom, this is an average member of the industry getting a replacement ratio of about between 28 and 31%. And what we've modeled here is that every year people exiting and what the observed preservation rate. So, and then people restart again. And you can actually see that it doesn't accumulate much over time. And the reason is because people are cashing in their savings at the younger ages because of small balances, because things are difficult to preserve, and various other reasons as well. Yet that savings at the early age is the savings that's going to contribute the most to retirement. So what Treasury's done is, we think, is quite smart. And if you follow the two-bucket approach, this line over here shows the minimum that one could expect. It's the 70% part of it. And the difference between that and the current system is about 2 times. So you would expect about a replacement ratios to go from 30 or 31 to 60, to double that for future generations by moving to the two-bucket system. And that's this, as we mentioned previously, it's the single biggest issue for not getting good outcomes. If people also preserve some of their short-term savings bucket, but still using the similar behavior that we see at the moment, you can see that there will be an uptick over here. So the range of outcomes in future is somewhere from 2 to 2.5 times, which gets you closer to that 75%. If people were to preserve fully, and remember this is over a 40-year period, people would definitely get to the 75%. What this is telling us is that the design of retirement funds is good when you start out. People are able to get to the 75. It's the behavior over here that happens over decades. And the two-bucket system is a good way to move forward. But Ncheki will take us through some of where we see that going. Then a hot topic for us, obviously, and for you all, you'll probably have a lot of questions around COVID and what we saw during the period. And this is just a summary of what we saw with various factors. So the first thing is in terms of contributions, you'll all recall when the lockdown happened, it happened very quickly, and lots of businesses had to get relief from government, but also they applied in the industry, and we worked very hard with the regulators to get relief for retirement fund members so that they could reduce their contributions. What happened during that period was a reduction of contributions, um, especially the retirement portion, and trying to, as far as possible, maintain the group risk and disability and funeral premiums. Why? Because during COVID, as we saw, the deaths increased, and that's when you actually need that cover. Most employers actually maintained that in place. Unfortunately, some had to be liquidated. They didn't make it. But in our database, because it's more the medium and large employers, most of them are still around, um, and they actually put relief mechanisms in place. 30% of the funds implemented contribution holidays or reduced contributions during the period, but by the end of the year, only 5% still had that in place. So the majority are contributing back at where they were, and you can actually see it that the average contribution at the end of the year is roughly similar to what it was at the beginning. Um, so there was an impact in the short term, and I think this is a good example of balancing short term and long term. Yes, people lost out on savings for a few months, but on the whole, they're back on track now for the and to make up that few months of contributions in the bigger scheme of things is it's not too bad. And it was great to see the industry coming together to provide some relief over there. What we do expect, though, is going forward in this year, there's still expected to be some more retrenchments. Some industries still haven't fully recovered. There is light at the end of the tunnel, but we expect some more retrenchments and over here. But I think the worst is definitely behind us. On the investment returns front, investment returns have recovered quite strongly. And you saw yesterday, that the market's actually not looking too bad. That being said, though, we do expect quite a lot more volatility in the short term. Um, and also, if you look at real returns over the last 5 to 8 years, it hasn't kept pace with a typical fund target of inflation plus 5, inflation plus 6 to get people to that replacement ratio of 75. So although it's getting there, the last few years of returns haven't helped. And we expect it going forward, it's going to be tough to get the inflation plus 5, inflation plus 6. However, that's being offset by the next factor, which is the cost of securing an income at retirement. As I mentioned earlier, during 2020, the cost of securing actually improved quite a bit. And as a result, we've seen an increase in life annuities. So more people are getting protection for their longevity. In the past, most people were taking living annuities or cash. We're actually starting to see more people take life annuities, which is actually a very good sign. And where hybrid annuities are in place, we're starting to see people use some of it for a life annuity to hedge their mortality risk, given where rates are at the moment. What we found very interesting during COVID is that the preservation rates, interestingly, didn't change much. In 2019, it was 48.3. This year it's 48.4, based on asset size, based on the number of members preserving, actually increased slightly. But you must remember that what's masking that is also initiatives put in place by retirement funds to improve behavior, improve outcomes, and we've definitely seen that happen. What this also tells us is that the reason for preservation isn't necessarily always short-term challenges from individuals. It's actually more things like people not understanding, the administration not being easy to make a good selection, make it easy to preserve. And Ncheki will take you through where we've seen some of those things actually work. But very interesting, preservation hardly affected by this, which means preservation, the reason for it, and non-preservation, it's not because people are struggling. There's other reasons that also contribute to the low preservation rate, which actually need to be addressed by things like the two-bucket system and defaults, etc. And then the last one that we saw during COVID, in the analysis this year, we didn't see a big increase in the group risk premiums because insurers kept those premiums for various reasons at their current levels. We are, however, now starting in 2021 seeing big increases, because you all would have seen the ASISA statistics, huge increase in death claims, the higher values of the death claims. Also, with the economic conditions and people being financially stressed, we're expecting that disability claims in future are also going to be higher. So that's going to create pressure on retirement savings because, as I mentioned right at the beginning, your total contributions minus your group risk is what goes towards retirement savings. So funds are having to respond this year to huge increases in group risk premiums. We do expect, though, that that might be a short-term issue. It depends on things like the rollout of the vaccine. It depends on the impact of long COVID and that in the workplace. So it's quite important to put various things in place to try and manage these costs, but we can cover that a little bit more, a little bit later. The other effect during COVID was that millennials were the hardest hit by COVID-19 in terms of employment. You all would have seen the unemployment statistics in South Africa. This was from the actual database, and you can see the younger individuals were the hardest hit. And we saw it most of the retrenchments that came through this year or the last year were actually the younger individuals contributing towards the youth unemployment. And this is going to continue being a huge challenge in the industry because it's these years when they contribute towards retirement, it makes the biggest difference. But they're not even, getting jobs. So again, this is a big issue. This is consistent with other research. If you look globally, during tough economic times, it is often the younger generation that suffers the most because they've got the least skills and various other reasons. And we definitely saw it through, this period. The other interesting thing is that on the topic of millennials are the highest risk in terms of indebtedness. Here we can see in terms of the Presage credit rating scores, split between high risk, medium risk, and low risk. You can see the highest risk individuals are actually your early millennials, and there's a very high proportion of individuals that are medium risk that are early millennials. So the most financial pressure is actually sitting over here at the younger individuals. And that's why it's quite important with things like having more flexibility, in the workplace, to address retirement savings, etc. We also saw that in terms of loan defaults, it's the highest for millennials as well. You can see here that proportion of loans in default, you've got 14% of early millennials, where the baby boomers, it's much less. So again, it points to at the younger ages, people are a lot more financially stressed, yet that is the area where people can make the biggest difference in their retirement savings if they start early enough. Then a hot topic that's come about is the gender gap. And we touched on it in previous years, but this year we've done a whole section on the gender gap, which we think you'd find quite interesting. Back in 2012, you can see a big difference here between females and males in the workplace. It's almost equal now. Not quite, but almost there. So over that period. So access to work and getting into the workplace has improved over that. So that's actually a very positive thing, over the last number of years. What is interesting as well is that females in general, if you look at the stats that we've got, have high education levels. So you can see more females matriculated, more females having a university education and postgraduate qualification. So generally, it's at the margin, but it definitely, females generally have high education levels. Despite that, though, we're not yet seeing as much females in senior positions, and that's still, and we think it's starting to change now with COVID, with remote working being more available, more flexibility, etc., and awareness around these issues becoming more prevalent. But still, in the senior positions, there's still quite a big difference, and that's despite females actually having, in general, higher qualifications than males. So there's still quite a bit of that needs to happen here. Companies addressing policies to look at that, and I think that's quite important. What is interesting is if you have a look at financial stress between male and female. Generally, females seem to be managing finances a little bit better. We haven't unpacked in depth the reasons for that, but key statistics here is, the debt to income ratio of females is 74% versus males is 80%. So males are more indebted than females. Males have more unsecured credit than females. Males have more proportion of loans in default, and their presage score is also slightly lower, than females. So you can definitely see, for various reasons, it seems that there is definitely a difference between male and female in terms of how they manage finances, etc. We also see that coming through here, that the debt to income ratio, a large majority of females have what's termed what we consider an ideal debt to income ratio. It's typically considered to be between 20 and 40%. Again, depending on a person's age, what you're doing with it, but the rule of thumb is about a 20 to 40% is probably ideal or reasonable. And you can see most females sitting in that category. Males, on the other hand, having a much higher debt to income ratio, and the outliers, people with very large debt and financial issues tend to be males, if you have a look at it over here. And that then spills into behavior in terms of contributions, preservation, but also the workplace, in terms of productivity, etc. For the first year now, and we'll send you the slides so you don't have to worry about the detail, but you'll be able to see the analysis when you get it. We've been able to look at correlation between people's financial well-being and their contributions. This slide shows the number of individuals in a household versus their contribution rate. And you can see the more people in the household, the lower the contribution rate. The less people that they're supporting, the higher the contribution rate. So, and you can see that the impact for females, they're more responsive to changes, and it speaks to females supporting individuals, in the household, and then looking, and again, if you tie that up with the financial behavior and decision making, it seems females generally more active, looking at managing and balancing finances over here versus males. Also, if we have a look at this is microloans. So the more proportion that you have in microloans versus contributions, you can also see that there is some correlation over here, and not as much as definitely there's more correlation in terms of the household makeup and what people are supporting. What is interesting is in loans in default. So the proportion of loans in default is on this axis, and we can see the more proportion of loans in default, the lower the total contribution rate for both males and females. What I'd like to point out on this graph is, so there's definitely an impact between household, how much is being supported, and other issues like indebtedness into retirement savings. And that's why it is important to look at short-term and long-term goals. And that's why things like the two-bucket system is actually quite important, because you need to look at those things. That being said, though, not all of the difference is explained by these factors. So not all of the difference in people's contribution rates, preservation rates, is explained by their individual circumstances. And that means that a lot of the non-preservation, low contribution is actually member apathy rather than their financial circumstances. That can be addressed through things like defaults, better communication, etc., which Ncheki can talk to us. But it is a myth that actually, people aren't preserving, for example, or saving because they've got debt and other. Actually, that's only a small portion. A big reason why people don't save, etc., is because of access to savings, understanding it, making it simple, and So I think it's quite important to recognize that. The other thing that we thought we'd set out for you is the gender gap in terms of wages. This is quite a sensitive and hot topic, and we've been able to analyze pensionable salaries over essentially a 10-year period, starting from 2010 to 2020, and you can see that there has been improvements over the 10 years. So, for example, there are twice as many males in the 960,000 Rand pensionable salary range relative to females. So there's still a gender gap, which means that the amount being paid to females isn't as much as males. I'll give you another graph on that. But it is improving over the 10 years, but it's not improving quick enough. And just to illustrate that it is improving, the proportion of females in the high band is now 7 times more than it was in 2010. But there's still a big gap here at the higher earners between males and females. There's other research in the industry that shows that also the representation of females on boards in the country is still quite low as well. And those would be individuals earning up here. And that's why companies are taking this seriously in terms of disclosing what's earned, needing to have policies around gender, making sure that there's equal pay, etc. But clearly the stats are showing that there has been an improvement, but there's a lot more that needs to happen in terms of that. And this shows it quite clearly. On average, for every rand that's paid to a male, females get 83 cents. And again, there's lots to unpack over here in different types of roles, experience, industries, etc. But on the whole, there is definitely a gap here. This gap is also consistent with overseas statistics as well. And you can see it here for different industries. Some industries are more, there's a bigger gap than others. So again, this also leads to outcomes being poorer at retirement ultimately, if these things aren't addressed. And to illustrate that point, and then I'll close off with my section, is the impact on the replacement ratios. As I mentioned, the overall replacement ratio is 31.47%, but it is lower for females than it is for males. Males are getting a 35% replacement ratio. This is actual retirees, females 26. And you can see it, all of the different replacement ratio ranges. Females definitely more at the lower end. And the reason for this is decades of inequality, breaks in careers to look after family, wage differences, and also having to manage finances if you've got less. Also, remember, the cost of converting capital to income for females is higher because females are generally expected to live longer. So technically, females should be saving more, preserving more, but actually it's the other way around. So there's quite a lot that needs to happen in terms of addressing the gender gap, so that ultimately that can improve, replacement ratios, on the whole. But that's it for my section. I hope that's set the scene in terms of what the challenges are, what the trends have been, etc. But I'm going to hand over to Ncheki, who's going to take you through, okay, so what can we do to improve these outcomes and what she's seen in practice that actually works to move the dial. Over to you, Ncheki.
Please just let you aren't able to see.
We're still waiting, so just give it a sec. It's not yet on, Ncheki.
Yeah. Let me try. I'm going to try again.
Yeah, something's happening there. It's not yet on though.
And now?
Not yet. if you want, I could put mine on, and then you can just tell me to change it if need be.
Okay, please do. I'm not sure why. It's actually not.
Okay, I'm going to do that quickly. Okay, just give us a second. It's busy loading, and then we'll continue over here. But I see there's been quite a few questions, you know, on the chat group, and I can see Belinda and Vicky have been responding. So if there's any more questions, please feel free to, you know, send it there while we go through everything. All right, I'm just going to skip over to get to that section, Cheki, and then you must just then tell me how to skip the.
Okay, thank you.
Just giving you all a quick refresh. You can.
I suppose it's the break that is actually needed.
Yes. Okay. And I just want to confirm that, I mean, we weren't able to put all the statistics in here. The report was just too long, but you'll get a copy of it this afternoon. There's lots of detail, you know, that we think you'll find interesting. Okay, there you go, and Cheki, but you please tell me, and I'll change when you want.
Yeah, you're almost there. Thank you. Just to summarize.
Cheki, I think because the signal's quite low, I think turn your camera off and it might improve.
Is it better?
I can hear you now.
Thanks, Kansi. Just to summarize the main challenges, it's the low preservations. It's nothing new there. We know it. I'm going to take you through what we can actually do to improve this. The low contributions, again, nothing new there. And the level of indebtedness. So members are in debt. And as John has shown in the analytics earlier on, gender inequality. So that one is coming, though we're seeing the gap is actually closing, especially over the past decade. Ineffective communication, which leads to poor decision-making by members. And of course, COVID-19, which just exacerbated the existing challenges and risks faced by members. Thanks, John. So the main purpose of having the reforms was to address the lack of savings. So, I mean, we've seen this has been quite topical. The proposal by National Treasury to have a two-bucket system, which will actually improve the outcomes. How this is going to be done is by allowing for greater preservation with limited pre-retirement withdrawals from retirement. So if this is done correctly, as John has actually indicated, this will actually improve the outcomes, particularly for the future generation. And I mean, what's more important with this is making sure that this solution is able to balance the long-term retirement savings goals together with the day-to-day short-term financial needs. So we are still waiting for the formal proposals from National Treasury. They did indicate earlier on that these will be ready in time for the midterm budget proposal. However, with the complexities with it and making sure that, you know, there is the right balance between long-term retirement savings and the short-term financial needs, we may actually only see the formal proposals early next year. However, having said all this, we can't just fold our hands and just wait for the two-bucket system to be legislated. There is more. We can do something. And in fact, we need to do more to be able to improve the decision-making by members. So I'll take you through, thanks, John. I'll take you through some of the interventions that can actually improve the outcomes. So if we look at the integrated advice frameworks, so when we work together with employers as well as retirement funds, making sure that we actually partner with members, it does work. And with the integrated advice frameworks, it helps us in actually designing group arrangements that meet employees' needs, that are outcome-based, and also making sure that they're aligned with the treating customers fairly outcomes and principles. And a need for mature and robust retirement benefit counseling. Yes, it is legislated. There are minimum requirements that you need to provide factual information to members on when they join a company and joining a retirement fund, when they actually exit and at retirement. And this needs to happen at least 3 months before a member goes on retirement. But that's just the minimum of it. So we can actually do more here. And when we actually do more, especially with the retirement benefit counseling and the education component, members are able to actually make the right financial decisions. As John has earlier indicated, that you'll be surprised that it's not that members are highly in debt that they're not preserving. It's the lack of education, it's the lack of knowledge. And of course, the financial literacy and training. So there is a greater need for education programs, helping members. So an example of it is helping members reduce the debt. And by them reducing debt, then they can actually start focusing on their medium to long-term goals, and your longer-term goals being your retirement savings. So when we partner with the members and making sure that they also take the necessary responsibility and contacting the retirement benefit counselors, we're able to see improved outcomes. And of course, inclusive financial advice, making sure that there's great accessibility to financial advisors. We take these things for granted in most cases that, of course, members know that they can actually phone a financial advisor. It's not that easy if you don't know who is the right person that you can actually trust in making sure that you get the right decisions. So we need to make sure that, these financial advisors are actually accessible to members. And of course, digital innovation. I mean, John has shown earlier on that interestingly, only 14% of members actually do not have access to internet. So this tells us that, we need to have some innovation. We need to be able to engage with members digitally. And I mean, across the different platforms. I mean, one being popular being the WhatsApp, with about 66% of members using it. Thanks, John. So, I mean, I will say effective member engagement is critical. I'll repeat this. Effective member engagement is important. It's vital in making sure that, we are guiding member decisions so that they improve their outcomes. And there is more that we can actually do, and we need to do better communication. There is a requirement, and we're seeing it. And I mean, if I will give you an example a little bit later with some of the clients when we consult with them and when these are implemented effectively, what the outcomes are. So I'll give you now examples of what we are actually doing at Alexander Forbes, that and obviously being able to show you the measurements and the impact that is showing. So one of the things, or one of the elements, is we have introduced the My Money Matters toolkit. So this guides employees in making sure that they make informed decisions about their money. So this happens at different phases. One being starting a new job. I mean, it is a big change in one's life when you start a job. And with that, you need someone to actually assist you in making sure that you make the right financial decisions. And this is where we actually bring our retirement benefit counselors together with financial advisors to assist members in making the right decisions, whether it's the contribution rate, that members can actually contribute a little bit more towards retirement, helping them with their day-to-day needs. And when they leave the employer, we need, again, there is a great need, and this is what we provide in terms of our retirement benefit counseling. We're able to engage with members, and with that, we're able to assist them in making a decision in terms of what can be done with their retirement saving, and that if it's invested and saved for retirement, ultimately they will be able to have better pensions. And of course, at retirement, when they're retiring from their employers. At that point in time, I mean, probably retirement is one of the biggest life-changing and biggest decision any member can make with their biggest investment. And I mean, this is not just a financial decision that they need to make, it's also an emotional one. So it is a journey that we need to actually assist members. So that's why I keep saying that though it's legislated that, you know, this needs to happen 3 months, at least 3 months before a member goes on retirement, but there's a greater need that this happens sooner rather than later, just to help them on an emotional basis, and also for them to start planning for retirement. And lastly, we don't just wait and for members to actually either join the company or get a new job or to leave the employer. We also help them while they're still actively members of a fund. Thanks, John. So with the retirement benefit counseling, we need to have it, and we need to have it when it actually counts. This is before any major decisions are taken by members. So we have what we call a basic retirement benefit counseling, as well as an enhanced retirement benefit counseling. I'm going to focus a little bit on the enhanced retirement benefit counseling. So immaterial, whether you've got the basic or the enhanced, we're able to assist our members when they start a job, when they are actually leaving a job, when they are preparing for retirement, and also in between, because we know that life happens in between. A lot happens, and there is also a greater need to help members through their financial well-being journey. So what we're doing on an enhanced retirement benefit counseling is we are proactively contacting members. And, you know, when you contact a member, just before they actually make that decision when they're leaving the employer, this does actually improve the outcomes. I'll give you an example with one of the clients that we actually consult to. They actually asked us to assist them as they were going through a retrenchment exercise. And during that retrenchment exercise, we're able to partner both with the Board of Trustees as well as the employer. So with that, we're able to actually have webinars across and roadshows for the members who were actually impacted. And quite interestingly, for all the members that we're able to talk to, and most of them were actually appreciative of us proactively contacting them, and 60% of those members actually preserved their benefits, whether entirely or a portion of the benefit. And again, I mean, one of the things is, as John has highlighted, members are not that highly indebted. It's just the lack of knowledge that's actually making them make the incorrect decisions. So I mean, one of the biggest examples I'll tell you is that, you know, you find that members will have 200,000 rands in their retirement saving when they leave, and they probably have financial pressures that only amount to 50,000 rands. But because of lack of knowledge, they tend to actually withdraw the entire benefit. So when you actually have your retirement benefit counseling happening at the same time, then they've got the knowledge that, you know, they can actually withdraw only 50,000 and preserve the 150,000. And with that, it does ultimately improve their retirement outcomes. Thanks, John. So we have a very interactive tool called the My Retirement Picture. So this is a very interesting and exciting tool. So it's I mean, as a member, they go through various stages or steps with it. So this helps them to be more confident, and they're able to prepare better for their retirement. So the first step is for them just a little bit information about themselves that they will include, and then it forces them to actually check how much they have actually saved for retirement. Interestingly, I mean, the number of calls that I get from members or from individuals when they're about to leave is that they don't even know how much they have for their retirement savings. So once they're able to actually engage with this tool, then they know how much they actually have. And that at that point in time, then they can look at what their expenses are. And with those expenses, then they can see whether, I mean, if they look at the various pensions that are available or the various annuities that are available in the market, then they can see whether they can afford it or not. And there's a great education component with the various annuities that are available in the market. And we are seeing a trend where more and more of members are actually going for the hybrid solution. So between your life and your living annuities. And solely because then there is a balance of that guarantee that is provided by life annuities and leaving a legacy with your living annuity. And once they're able to play around with the retirement picture and being able to engage with it, then it can actually provide them with a report. With that report, they can actually email it to themselves, they can print it. And once they have that picture, then it helps them when they actually go and talk to their financial advisor. Then there is the greater ownership from that particular member. It's no longer a consultant being cheeky, telling this particular member, this is what needs to happen, or a financial advisor. Then it's a plan that they're working together and the necessary interventions can be brought in with the help of the financial advisors. And quite interestingly, here in South Africa, we were just talking about it earlier on, that, you know, the members still prefer to have, you know, a human touch to it. They prefer in person, whether it's over the phone, whether it's over a Teams meeting, or whether it's a face-to-face meeting. But there is still that requirement when it comes to financial advice. And with this, it just provides them with a nice introduction. And once they have that interaction with the financial advisor, then they can actually improve their outcomes. Thanks, John. So now I'm going to be summarizing in terms of the impact when we look at the proactive outbound contact. So it's just shy of 96% of members who have experienced the enhanced retirement benefit counseling are more confident financially. So just shy of 96% of the people are saying that they are actually confident in making retirement fund decisions. And this is after they have actually engaged with our consultants. And just a little under 80% of members actually are now they understand what their retirement fund benefits and the options. And you know, we tend to take these things for granted, that of course the employer provides these benefits and members understand these benefits, but in reality they really don't understand them. And with this, when someone actually contacts them and explains this, and there is some financial literacy programs available to them, then they're able to actually make the right decisions. And I mean, if you look at our average response rate, in terms of the SMS, we at Alexander Forbes, it's 28% versus the industry average of 20%. And on email again, it's higher. We actually we are at 15%, where the industry average is sitting at 10%. So in terms of the overall customer satisfaction score, we're sitting at 9.1, which has improved. So this score is in July, and this improved from 8.9 just in May and June. So you can just imagine, if we continue on this basis and proactively contacting members, how this is going to actually improve the customer satisfaction scores as well. So on average, 9 out of 10 members were actually satisfied. And this is the rating that they have provided, with the minimum. In fact, none of their members actually scored less than 8 out of 10. So this just shows you that, you know, it does work. And where it is implemented correctly and effectively, outcomes are actually improving. Thanks, John. So when we look at the digital exits and its impact, so 300 employers have actually signed up for it. And out of those 300 employers, we have seen that, there is an increase in the overall preservation rate by value, which is now sitting at 53%. And again, of members, so 30% of members actually remain invested. So, I mean, this, if you had to compare it to the overall picture of sitting at about 9% in the industry, you can see that, immediately when we do these things correctly, there is greater improvement. And there has been a 7% increase in terms of members who made active preservation decisions. Again, when you provide the necessary information, when you educate people, and the education does not happen when they're about to make a decision. This is throughout. Then they're able to make informed decisions. Okay, thanks, John. So if we look at my retirement picture and how interactive that tool is and the engagement of it, I mean, we did some testing. So if we look at for members who are pre-retirement, just in the first quarter of this year, so 520 people were actually using that platform to date. And out of those people, about just more than 90 of those members actually spent between 10 to 30 minutes, and more than 30 spent over 30 minutes. So this tells you that, they are interested in the information, and it helps them in terms of their retirement planning. And I mean, we've seen previously, I mean, we all know that, people just click, and if they spend even a minute of it, that's just too long. So it's when you provide the right tools that actually talk to the members that are simple enough for them to actually work and interact on, then we're able to see an impact and improvement in terms of their outcomes. And of course, we have pre-retirement seminars and sessions, and this again helps in terms of improving the outcomes. Thanks, John. So just to conclude, in terms of what we can actually do to improve things. So it's a combination of everything. So we're not just going to be sitting around and folding our arms, waiting for National Treasury and, for the two bucket system to be legislated. And this only, going to be assisting more the future generation. There is more that we can do. And if it's done correctly, it does improve the outcomes. However, we need to be in a position to partner with members, and members are able to partner with us if the information that we're providing to them, we're able to do it in their languages, and it makes it simple enough. And there is that interaction with the tools. There's a report that they can actually print. And if there is a need, they're able to actually consult. So there is more that we still need to do as an industry. And we are definitely seeing that, there is great improvements. So thank you very much. I will now hand back over to John just to take us through the Q&A part of this presentation.
Teki, thank you so much. That was, really, really insightful with some practical examples of how some funds are actually getting things right. Well, that everybody concludes the presentation. I hope you found it useful, and hopefully you've seen, I think there's some new information, in terms of enhancing the retirement database with other information. So for the first time, we see all these linkages. As I mentioned, there'll be a report available, a recording, the presentation, and that'll be, and as well as a press release that's going to be coming out after this session. So you'll get all of that, and please feel free to also contact any one of us. You can, or via Konzi and Sherry. If you'd like to have a one-on-one look at some detail, if you have any questions, there's probably lots of things in that report we weren't able to cover here. But this is just what we thought would be interesting for you, that's different from what you've seen before. I'm going to pause there and just see if there's any specific questions. I know that Vicky and Belinda have addressed a lot of the Q&A as we've gone along. Any other questions before we wrap up the session?
Maybe, John, if I may, I mean, you're more than welcome to contact us afterwards if you've got any other questions. Both John and I or some of our colleagues will be able to actually respond to your questions. So all you need to do is just speak to Consi.
No, thanks.
Yeah, and Londiwe's got a question. Londiwe, do you want to come on mic?
Hi, everyone. Yeah, I've just wondered whether I know we're all still waiting for the official, recommendations, or not recommendation, but official policy from Treasury. But from your point of view, what you think should be in the preservation bucket. And I'm asking that because we saw last week one recommendation saying probably 2/3 of the savings should be in the preservation bucket. But I also imagine that would not sit very well with the labor unions. Have you looked at what would work?
Yeah, so I think the reality is, you need to take a number of factors into account, with that. If we have a look at countries like Botswana, actually have 75% that is in the preservation bucket, but they started a lot sooner than what we did. So I think ideally, you remember the retirement savings is actually there for retirement. So it's a bit of an anomaly in South Africa that people are using it for various reasons on exit, and in many cases, not because they need it, just because it's there. And there are definitely needs. So as we mentioned, the short-term needs, people are financially pressed, but it's not the full amount. So I think definitely, and on balance, you need to also remember that people have other options that they could use instead of retirement savings, for other needs. So we must also take that into account. So we definitely believe that, and also you've got to take practicalities into account. In South Africa, there's common understanding of 1/3 at retirement, 2/3 in a pension that you must annuitize. So I think there's a lot of merit in the 2/3, 1/3. So the merit is that for retirement savings purposes, you actually want it closer to 100, but we do know that you need to focus on, there is relief needed. So you want to try and get as much as possible, but I think people understand the 1/3, 2/3. At retirement, you can take 1/3 in cash, and you can take 2/3 to annuitize. So if you just take that and apply it throughout an individual's journey from when they join, it actually makes it's a nice, neat solution. With regards to unions, yes, I think, but remember, unions also had the issue with T-Day. So T-Day, they had the issue with provident funds annuitizing. Provident funds going forward have to also now annuitize 2/3. So again, there's a lot of engagement that's needed with the various stakeholders. We think that Treasury's done a really good job, but we do think it's going to take a bit more time than what they originally indicated. And in the end, the unions accepted the 1/3, 2/3, for provident fund, but it was with certain concessions like grandfathering individuals, accumulated savings needed to be treated in provident funds like they were. We expect similar type of concessions coming through for, the two bucket. What that means is that in practical purposes, the two bucket system's only really going to help people in the next few decades. So it's the new generation. People that are closer to retirement within 10 years, it's not going to make that much difference. They still need to preserve, look at things, their rights will be maintained, etc. So, but hopefully, our view is the 1/3, 2/3 actually can work. It's practical, but there'll need to be some concessions. But we'll have to see what the end outcome is. I hope that gives you a little bit more, at least our view on that, Londiwe.
Yes, it does. Thanks, John.
Okay, perfect. Sorry, the other thing is that 2/3 goes a long way, as we mentioned. It gets you maybe not to the ideal 75, but 60 is a lot better than 75. So it actually can do the job. And many other countries, in fact, do more than that. So I think it's a good balancing act, you know, if one can land there. Okay, great. Okay, if there's no other questions, please feel free. I think we've come to the end of the session. Thanks so much for all your time. We've taken up the full time over here. I hope you've enjoyed it. We've really enjoyed putting this together, but there's lots of content. So please look out in your mail this later today for all the links, the extra info, and especially the report. And please reach out to us for any questions you may have. We're more than happy to take you through anything over there. But thanks again, and thanks also to the team who's here today, who made this happen. And then I hope you all have a fantastic day.
Thank you, John and Cheki.
Right. Well, cheers,
Thank you,
everybody.
everyone.
Well then.
Thank you.